Okay, gang. So we've been in this first section of the pathway talking about how humans' behavior predicts future market activity. So, that's kind of the key takeaway is that because humans are predictable, sometimes irrational, but irrationally predictable, then we can predict what's going to happen next. So based on how things are happening right now, that gives us insight into what do we expect is going to happen next. And for this segment, we are going to talk about markets as auctions. Okay, so when I first got started in markets, I lament to say that it took me a bit to figure out that what I was looking at when I was looking at a chart was an auction. So we're looking at these squiggly lines and trying to make sense of them, but essentially, what we're looking at is just a representation graphically of an auction that's taking place. That was really insightful for me. And if you've read any of Dalton's books like Markets and Profile or Mind Over Markets, he stresses this. That was helpful. I remember when I got the Chicago Board of Trade Market Profile manual, it stressed that as well. Just doing that to call to the mind that, yes, markets are auction, and most of us know how auctions work. Right, so let's kind of walk through like how auctions work and how they function and how that gives us insight into what we're looking to do in a market in terms of predicting what's going to happen next. So first of all, there are different types of auctions. So one is a fixed auction. Okay, so what's a fixed auction? So a fixed auction, there's like an open, basically the auction is open. There's a bidding process, and then there's a close, and then it's done. Right, so. This may be we're at an arch sale or we're in a state auction where there's a set lot that's being auctioned off. It starts the process, and then what do? As people come in, they bid up till the price gets to a place where nobody else wants to be active, and then we're done. Or it could be a silent auction where it's set for a period of time, and people will put bids as long as that's open, and then we're done, right? That is a behavior that we know. eBay kind of works like that. A question around those types of auctions is, what drives participation in auctions, specifically in those auctions? So within a fixed auction, what are some of the drivers? One of them is like the quantity of units. Like, how many of this thing are there? Is it in high demand? Is it a one of a kind? There's a quantity that drives that, right? Second is the perception of value. Where is this relative to whatever participants perceive the value to be? And then it could happen to be that just the capitalization of the participants is another piece, right? So, if people have deeper pockets, they may chase it more significantly. And then, the emotions is the last piece. Does someone get caught up in that? I think that was part of how eBay worked, right? Was or some of these is like it works because there's a fixed period of time, and I'm like, oh, I want that thing, and at first it started as a deal, and now it's not. So we all kind of understand how that works. We can actually leverage that understanding to help us trade. Then we have to just put it into a framework outside of a fixed auction, and we have to think in terms of a continuous auction, right? And we have to understand like how are continuous auctions different from fixed auctions, because they're very different. For one, markets move. Hang on a second here. Markets will move up to a price to shut off buying, or they'll move down to shut off selling. So in a continuous auction, now we're no longer constrained to an auction has to go one direction and then it's going to stop. Like it goes up until it runs out of participants, and it goes down until it runs out of participants. So, if we were going to ask, what essentially ends an auction, markets rally when the last participant sells, and they sell when the last participant buys. Right? So let's look at a way to map that. All right. So I've shown some of you this chart, and what is this chart? This is a representation of the VIX curve. So when people talk about volatility, they talk about fear. They talk about fear and talk about the VIX. But here's how to be smarter at parties. One is to recognize what exactly is the instrument that we're looking at, and how exactly does this work. Now, why do I have this like this? Well, we're going to look at a couple things. One, we're going to look here. Okay, now notice on this chart there's VIX, but there's VIX 1D, there's VIX 90, there's VIX 3M, 6M, 1Y. What does that all mean? It means that these are indexes based on pricing of options, which are the vehicles that participants go to hedge risk when there's greater fear at different durations. So the VIX itself, okay, when we talk about the VIX, which I've got right there, okay, when we talk about the VIX, that's 30 days. Okay, so if you run across someone who says, well, when the VIX is at X price, I do this. So I'm going to tell you right now to stop listening to them because they don't understand that there's an aspect of markets that have changed. What is that aspect of markets that have changed? Is that beginning in November of 2023, greater than 60% of all options traded on a given day, the volume was in options that expired in that day. Now, does a VIX include that? Yes, but because it's 30 days, right? But it wasn't an accurate representation of where everything was. So now what we do is we look at other durations. So there's a 9D, which we consider weekly options, out for kind of the next week, and then there's the 1D. So what does this all mean, and how do we think about this in terms of that principle of markets rally when the last participant sells, and they sell when the last participant buys. All right. If I go out here to 1 year, that index price is considering and pricing in all of the potentialities that could happen in the market over the next year. Right. So that's how options are priced. Options are an efficient risk vehicle. Why? Because they're transparent. It's like you can go to Vegas and you're playing poker and you can see everyone's hand. Okay, this is remarkable. But imagine how people might behave if they could see everybody's hand. Right? They would be kind of constrained. They would only take really, really sure bets if that was the case. This is how the markets are. So if I have 1 year, that's going to be here. 1 day is now down here. Why? Because we got past whatever Powell was going to say, and you can actually see if I fan this out, there was a little bit of concern into Powell, and once he said things that was interpreted as dovish, boom, we took off. We just burned through that. So now we're back to pretty relatively recently complacent reading on the 1D VIX. And the 1D VIX is significant because it is where 60% plus of all options that are traded on a given day are at. Right? So, but we watch that. But we watch that relative to other expirations. So this is how you go from somebody who just talks about the VIX and talks about the VIX curve. Because it's the insight is not in the VIX itself. The insight of it is in the VIX curve, the relationship of the VIX to itself in other expirations. So right now, we have a situation where we would call this a normal curve. Why? Because every duration, so if I look at all of these, 1 year, 6 months, 3 months, 30 days, 9 days, 1 day, notice that they're priced lower, as we go down in time and duration. Okay, so that's the normal curve. The normal orientation of volatility is that longer dated should always be more expensive than the nearest dated. Right? Now, When that gets really stretched in terms of really, really complacent, and the distance between all of these is really wide, that's a place where we can say that the entire market is not fearful. So if I go back to this chart, what I've done is I've looked at the relationship of 1D to 1 year and 1D to 9 days. And it allows me to look across that curve and say, whoa, okay, now let's go back and look historically. This is about as extreme a reading as we can get in terms of there's no fear. So we would say that this is an underpriced risk market. Participants are underpricing risk. They are not considering the things that could be out there. And there's some significant, we've got a tariff headline or deadline coming up. There's still open trade negotiations. We don't know if we're going to have a cessation to, this war. There's a lot of stuff out there, right? So if I collapse this and I look at this relative to the S&P 500, which is what the VIX tracks, all right, we're going to see some interesting things. So let's look at other times. Let me get a vertical line here. And let's look at other times where we started to see the markets fall or, have difficulty. They were always what was the performance of them after we had that level of complacency? We're going to go look at what those periods were like anytime that we were that complacent. And we'll also talk about it too. Like what's going on there. Because you're going to doubtless go look at this and go, wait a second. There are some of these that, we went higher. So what's going on there? This is insightful to talk about. So here are just a few where we had, some levels of complacency, and then how did the market behave after that? Now, let's look at this first one back here. Back in May of 24, we dipped below. Oh, there's one more here too. There's one back here in March 24, and look at the move after that, right? Here's the one in May. Now we get a little bit of a dip, but then you can see this rally as it stays complacent. And then as we start to move off of that complacency, is when this comes in. Here's one. As we get less complacent, we move lower. We get less complacent, we move lower. We get less complacent, we move lower, sometimes significantly lower, right? Here is where we started to print it, but notice that we've continued to push higher until right here we started to have a little bit of a wobble. We're starting to price in, and this is the natural thing that will happen, is that once you're in this complacent state, we don't know when exactly it's going to start to correct, but now we're at a place where it can happen and change very rapidly. The other thing that and we'll talk about this in additional sections, is different times of the year and how this impacts, because this is driven by options. So where we are now here we are at a spot where we're really complacent. We're back to the S&P pushing all-time highs, and we're going to watch this. We're also now in a period of the year where we're at max complacency. This is not a place where we're going to look to buy. Where do I want to look to buy? The safest buys are the alternative. So these spots where we have gone from underpriced risk to overpriced risk. Okay, when that happens, we went so fearful that everybody who is bearish is bearish. Well, that's the cure for lower prices. And once that kind of works its way out, as is the case here, and this reverts back below or back to a normal orientation, look at the moves off of those, right? Pretty, there's still, this one was really good. Again, timing of the year impacts, some of this, but when we get reversions, so we're calling reversion in the curve, that's when we see some, pretty significant moves. So let's look at what those reversions look like. is a little cluster. No, not that. You can see how that 1D shoots way above 1 year. So what's happening is there's more fear in the next day or two than there is a year out. That's unlikely to last. So if you ever heard people talk about like volatility is mean reverting, this is the mechanics of that and how that happens. Now, when it's inverted, caution. Like just because we see it inverted and we know that it's mean reverting does not mean that we start buying things, because I mean all we got to do is go back to COVID. We were inverted for a month. Okay? And in that period of time the S&P lost 10%. Like, we don't need to do that. Let's wait until we get to the other side. And just like we talked about in the prior sections about the curve, the diffusion curve of innovation, I don't have to be the innovator. I can be in that chasm between the early adopter and the early majority and have all kinds of opportunity, right? So like where we are right now, anybody tries to short right now because we're complacent, so that we're there. That's going to be the innovator. That's the person who's trying to pick the top. They are most likely going to get squeezed. It's not going to work out for them. Let's wait until we start to see this volatility start to move back together. And then it's the acceleration that will lead to those prices lower. Okay, so this is all part of thinking in terms of the fear curve. This is behavioral, right? We've been talking about that we're not technicians, we're not fundamentalists, we're not quants. We can use all of that and we look at it from a behavioral lens. So again, markets rally when the last participant sells and they sell when the last participant buys. So if we think about that, I mean, that gives us insight into how humans win in auctions. Because at the end of the day, that's what we got to try to take this into. It's like, how do we win in an auction? Well, one is I won the thing, right? Like I just want to own that. And that was the primary driver. And that's what I want to do. So I'm gonna purchase this asset. I'm gonna purchase this thing, whatever. That's how you can win. Or I got a good deal, right? I got a good deal on this thing, relative to what, right? Like how do I know that I got a good deal? And it's here where we start to think about the impact of value on auction behavior. This is like, as you go through this pathway, this concept of value is so critical to how we think in a way where we can show up consistently over time. And it's everything. So what's the key principle? The principle is that auction participants will buy aggressively up and into value, and they will taper off once above value. So what does that look like? So when we talked about this, innovation curve here, right? And we talk about, it's tracking with how participants act around something. Somebody's early, they're gonna trail this. They're gonna basically trade this thing up until we get the bulk of everyone there. That's where the mode is, and then we'll continue past that until we've sucked in the laggards. Right. So the question there is, what is the difference of price and value as it relates to the auction? Right. What is the difference of price and value as it relates to the auction? So a couple things to think about. One, price is the advertising mechanism to see if participants will engage in trade, to see if that is attractive to them. And how do they know whether it's attractive? Is value is the result. It's what's built as a result of the price discovery and the participant reaction. Right. So when I see, and we're talking about this in the next section, when I see something like a volume profile, let's just get a really simple chart here. Okay. So when I see a chart like this, where I've got, these are daily bars in NVIDIA, let's even clean up a bunch of stuff. Let's just look at just what we want to look at. All right, so this is just a volume profile that's fixed based on, we're just picking, at this point, we're picking an arbitrary period of time. But we can see this volume profile, which covers this whole period of time, is showing us where has been the largest bulk of trade. Right? So at 118.13 is the largest bulk of trade. And over this period, so like right now we're looking, this is going back to 24. This is like a 2-year period. So over this period, value represented by the most traded price, which is an objective measurement, is here. So where's price? Price is here. Now, does that mean that we don't go higher? We don't position higher? No, but it does become part of the rubric. Now, what we'll do is we're going to dive down into what time frames to look at, because while this is a 2-year, this is not a time frame that anybody trades off of. Okay, very very few people are making decisions based off of this time frame. So you can pretty much just knock this out of the park. What we would instead do is we would go look and say, okay, well, let's look at like a 3-month time frame. Where is value there? Okay, so over the last 3 months, and why 3 months? Because it's quarterly. It's relative to, related to earnings. Okay, over the last 3 months, where's value? 144.13. Now, do we see any other prices that specifically stand out that if we spent a little bit more time there could become value? Right? I see a couple. I see one here. Like that's value right there, but right? I can see a couple candidates kind of right where price is. And so what, how do we think about that? We think, well, what's happening is that participants are accepting these prices, which we're going to talk about acceptance, rejection, but they're accepting these prices. And so what's likely to happen is that value is going to follow price. And that's also insightful. So that will be a question that we'll talk about as we continue on too, is price pulling value with it, or is value following price? But all of that is part of, what are participants? If value follows price, like here's a preview for when we dive into this more specifically. If value follows price, that's essentially also saying that there's built up energy here that can allow this thing to now express and explore even higher prices. Okay? Before, let's make this kind of tactical. Before we saw this little top here at 184, let's look at the profile. See how different that is? So at 184, what's going on? I got a really diminished profile. I'm running out of participants as the auction's going higher. So tap into your brain, the part of your brain that understands how auctions work. When is an auction nearing its end, or the phase of it to end? When I'm running out of people. When the auctioneer is like, can I get a bid? I came from the ag side. So, if you got somebody at cattle auction, it's like, get 5 or I don't know. It's amazing what these guys do. But when no one else is raising their paddle and it's just fewer and fewer, and people are just kind of sitting, what do we know? We know that is starting to get exhausted. It doesn't mean that it's over yet, but it's nearing it. And then what's going to happen next? What's got to happen next is that we have to try to see if we can build value at these higher prices. So what happens next is NVIDIA trades up here. Watch how we shift this profile, right? We are effectively pausing to trade sideways and accept these prices. So when we talk about, there's really only 2 behaviors in a market. When you've seen a trend and the trend is clear, you have to ask yourself, what's next? What is next? Sideways. So this is imbalanced. This is balanced. What's going to happen next? Imbalanced. What do we got coming up that could encourage that? Earnings. right? Where is that gonna, if it gets some legs, where is it gonna get outside of where we've been balanced? All right. So that, my friends, is a step into thinking about markets as auctions. And when we have our next session, we'll talk about how to use, we'll dig further into how to profile the auction specifically, and what are we specifically looking at? What are some of the time frames, so that we can kind of pull all this together. Okay, sweet.